Hi, I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my video interview with my colleague, Scott Chan. Scott Chan is the lead analyst of real world investing and the complete investor. I sat down with Scott today to discuss China and a range of related geopolitical topics. I know you're a busy guy. Thanks for carving out time to be with us here today. When international events heat up, you've become my go-to guy to get historical and geopolitical context. Okay, let's get started. Scott, China has been hosting the Winter Olympics. It's now concluded. How big a deal is that to the country's economy and its international prestige? And what's it all mean for the global community?
Well, John, I monitor Chinese social media, and the sense that I get is that the excitement is definitely not nearly as great as it was for the Beijing Summer Olympics back in 2008. That was the first time that China ever hosted an Olympics event. And this time around, the pandemic simply took a lot of wind out of the sails, and China is simply not as much of a powerhouse in winter sports as they are in summer sports. And besides, China already had its coming out party back in 2008. Right. And so there's definitely a sense of, having done that and been there. And internationally too, there was plenty of politics going on with diplomatic boycott involving the US, Canada, and quite a few other countries as well. But what's most interesting about the Olympics to me is the official introduction of the digital yuan called the ECNY to foreigners. You could literally just insert dollar bills into a kiosk in Olympic Village, and you can get back digital yuan in the form of a card. Now, this ECNY is not a cryptocurrency because China bans crypto. And unlike a crypto currency, ECNY is fully backed by the Chinese Central Bank, the PBOC. Right now, the Chinese government is saying that it only wants to use the digital yuan for retail, but that's what you might expect them to say. You can bet that China wants to use the ECNY eventually to use it in international trade.
China has taken an increasingly authoritarian turn in its crackdowns on Hong Kong, its designs on Taiwan, and it's been turning the screws on the mega cap technology companies in its own country. What are the ramifications of this crackdown, especially on the technology sector?
Yeah, so Chinese stocks have always carried a stigma. One reason is doubt, fair or unfair, about the legitimacy of the accounting. Another reason is that the CCP can do whatever it wants, as we have seen recently. The crackdown on the tech sector definitely limits the upside of these mega cap Chinese tech companies, and that's been reflected in the falling stock prices. But I think it's important to make the distinction that the crackdown has been limited to consumer tech companies. These are the kinds of companies that provide technology that make everyday lives more convenient or more entertaining. For example, maybe shopping online more seamlessly, or the ability to download a game or movie faster. Frankly, I think these are pretty frivolous stuff. China, excuse me. Note that China hasn't touched tech sectors like semiconductors. So China definitely knows what it's doing in terms of prioritizing, what's important to its standing in the world. Note that it is our government that's trying to crack down on strategically important Chinese tech companies. For example, Huawei. As far as how China's crackdown on these consumer tech companies affect U.S. investors, I think that other than unfortunately losing money in stocks like Alibaba and Tencent, that is if you happen to own them, in the big picture, I think that the impact is going to be minimal. These companies will still grow, just slower than they would have otherwise without the crackdown.
The U.S. Federal Reserve is tightening, but meanwhile, the Chinese central bank is loosening to stimulate the country's sputtering economy. How badly is China's economy slowing? And what are the ramifications for global investors of China's dovish monetary turn?
Yeah, so according to the latest official data, the Chinese GDP still grew 4% in the fourth quarter last year. And for the full 2021, the growth rate was 8.1%. And that was actually the fastest annual growth rate they've had in a while. Now, of course, the comparison was to 2020, which was deeply impacted by COVID lockdowns. So you could argue that it was a low benchmark to beat, but also keep in mind that in 2020, the Chinese economy actually grew. I think it was 2.2%, while all other major economies shrank. So the benchmark really wasn't that bad or weak to compare to. So 8.1 is still pretty good. The fact that the PBOC is easing, though, suggests, definitely there are some downward pressures. But to put things in perspective, the 1 month lending rate, which is their benchmark rate, interest rate, was cut by only 10 basis points from 3.8% to 3.7%. This was actually just their second cut since April 2020. The first one was actually back in December 2021, and that cut was only 5 basis points. So, putting things into perspective again, it's simply not that bad. Plus, China's inflation rate is low, so there's still plenty of room to cut if the PBOC sees fit. And as of January 2022, the inflation rate in China was under 1%. I believe it was 0.9%. Now compare that to the U.S. inflation rate, which in January was 7.5%. Now with China, with China going to dovish mode, on the one hand, that's good news, for international companies that benefit from a growing Chinese market. But on the other hand, we know that China is going to push for more construction and infrastructure projects. In fact, the central government has told the local governments in China to be more active in infrastructure investment. What that means is going to be more demand for commodities, and that's going to drive up prices for the rest of the world. So for countries like us, that's already dealing with a high inflation. That's not necessarily a good thing. And as investors, we just have to be very wary of high inflation and position our portfolios accordingly.
Right, that makes sense. During the Ukraine crisis, we've seen an increasing coziness between Russia and China, that Beijing and Moscow seem to be creating a new axis of power to counteract the United States. What does this mean for global investors? What does this mean for the balance of power in Eastern Europe and around the world?
Yeah, as the saying goes, the enemy of my enemy is my friend. And I think that's pretty much what's going on here with China and Russia. It's in the interest of both countries to reduce American influence in that part of the world. I think that if you took the US out of the equation, Russia and China are more likely going to be rivals than allies. Both countries want to reduce the dollar's influence. In fact, whereas trade between Russia and China used to be almost entirely settled in US dollars, over the last 6 or 7 years, things have changed quite a bit. Nowadays, bilateral trade between Russia and China is mostly settled in the euro. Now that's the euro is still a third-party currency, so chances are, China will want to see if eventually it can work the digital yuan, the ECNY that I mentioned earlier, into that relationship. Now, a very important feature of the ECNY is that it doesn't use the SWIFT system, which is what enables the US to impose sanctions and freeze financial assets. So by using the ECNY, Russia and China would likely be able to subvert potential US sanction. And perhaps to increase confidence in this new digital currency, China could decide to at least partially back it with gold. And in terms of the investment implications of the alliance, the friendship between Russia and China has actually been intensifying for quite a while now. If the alliance becomes more contentious with the US and with the West, to the point where we get more serious sanctions and tariffs, then I think the most likely effects would be persistently high inflation, high commodity prices, especially in energy.
Scott, China's debt problems have shaken global investors. These debt woes are epitomized by property developer China Evergrande Group's inability to meet interest payments. There's a fear that China Evergrande Group could become another Lehman, the investment banking house that collapsed in 2008 and exacerbated the 2008 financial crisis. How bad are the debt woes in China? Are they being overstated? And what's it mean for investors around the world?
Yeah, I think we've all heard about the comparison of Evergrande to Lehman. I don't want to downplay the situation because there's definitely a lot of money at stake, but I don't think the level of contagion is going to be a repeat of the Lehman collapse and the ensuing financial crisis. Now, there are a lot of bad things about the CCP, but in a crisis, an authoritarian government can get things done fast. I mean, just look at how the CCP dealt with the COVID outbreak. Yeah, it was definitely very heavy-handed, but I don't think you can argue that China has been very successful in keeping COVID in check. Now, in regards to Evergrande, the government could bail the company out if it wanted to, but it looks like the government wants to make an example of Evergrande. So it's for now, at least, it's letting the situation play out. Stricter debt regulation was in fact what caused Evergrande to run out of money. So for the time being, Beijing is willing to tolerate some short-term pain to stop the debt bubble from continuing to grow and possibly make it impossible to control in the future. But at the same time, the CCP is not going to let things get out of hand. So I expect the government to intervene at some point if it looks like the problems in real estate might cause a recession. And like we talked about earlier, the PBOC has already incrementally lower interest rates, and if necessary, the government is going to do more. And I think that's likely going to include directed loans from their massive state-owned banks, for example.
Inflation. It's not just an American problem; it's a global problem. Inflation is spreading around the world. There are a lot of reasons for that, among them supply chain disruptions. What are some of your favorite inflation portfolio hedges right now?
Yeah, John. So at the Complete Investor and at Real World Investing, we have long been wary of the threat of inflation posed by resource scarcity. Real World Investing, in fact, was created to help our readers deal with this very issue of resource scarcity. We see two megatrends, very important megatrends, affecting every investor right now. One is the continuing modernization of the developing world, with China playing a vital role. The other is the global transition to renewable energy. Both of these megatrends require tremendous amounts of natural resources. Now, the pandemic definitely exacerbated the situation, but inflationary forces were already in place. We have long recommended natural resource plays as hedge against inflation, as well as for growth. And right now, with commodity-led inflation here, there's just no reason we don't see to change that recommendation. And these include, energy producers, miners, as well as precious metals ETFs.
Scott, this has been a terrific interview. Thanks for joining me here today.
Thank you, John. It was fun.
Yeah, it was fun. I appreciate it. In this interview, my colleague Scott Chan provided insightful investment advice for tumultuous times. He especially focused on the appeal of commodities and precious metals as investment plays that make sense under current conditions. For a high-quality gold play now, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, I'm John Prasinos, Editorial Director of Investing Daily. Thanks for joining us, and stay safe and stay invested.